and good morning, everybody. So I'm very happy to be here again at the Singapore FinTech Festival. I know there are a lot of entrepreneurs, founders, a lot of FinTech startups. We ourselves were there about 6 to 7 years ago. So I'm going to talk a little bit about our journey, some of the stuff that worked for us, some of the stuff that perhaps didn't work so well, and maybe for a lot of you guys out there, perhaps founders who want to aspire to build a startup and make it relatively successful, I might be able to give you a couple of ideas. So first of all, Boost is a fintech platform that is based primarily in Malaysia, and it has expanded into the region, into adjacent countries like Indonesia, Cambodia. We started off our journey as a payment platform. The center of gravity of our business very quickly shifted towards lending, digital lending using alternative data. And recently we kind of transformed that entire business into a digital bank. There were digital bank licenses awarded in Malaysia about 2 years ago, and we were lucky enough to grab one of those licenses. I'll start with a little bit of history. Like I said, Boost started probably in 2018. We started with a telco heritage. So we were owned by a company called Axiata, which has about 150 million customers across South Asia, Southeast Asia. And this was a time, if a lot of you remember, that wallets were proliferating. There was a lot of talk about the underserved segments, both on the consumer and on the business side. And there was a general thesis that, especially in Southeast Asia and perhaps in markets in South Asia, financial institutions had failed to deliver to a large segment of society, particularly those, or businesses, particularly those at the bottom of the pyramid. I think a lot of you are familiar with this story. So why did we decide to jump on the bandwagon and think that we, when I say we, as probably a telco back in 2017, had a right to play in this space? And there were a couple of reasons. One is fundamentally, we realized that a large number of our customers, both consumers and small businesses, because as a telco in these markets, you distribute through distribution channels, physical distribution channels. We are in what we call prepaid markets in Southeast Asia. We had a large number of partners, distributors, customers that overlapped with this segment that was broadly classified as underserved. So that was one. The second, we felt that we had a fairly strong brand presence. As you know, telco brands tend to be quite strong, and a lot of investment goes into creating brand presence and trust. And we felt that there was an element of a brand we could leverage. And also we had built up adjacent capabilities in data processing, in AI, in analytics, in processing large volumes of small transactions, which is really what the business was about. And we decided to embark on this venture. Now, some of the early learnings we realized was, yes, we had a large overlapping base. Was it as easy to capture that base? Probably not. Was it as easy to leverage a telco brand and convert customers who are using our mobile services into fintech services? A complete no. So we launched Boost actually as part of a learning we had where initially, our first go at this was to actually incubate a lot of the fintech services we had out of the telco mothership. And we realized that didn't really work. And it was only when we really carved everything out, separate brands, separate identity, agnostic. You did not have to be a customer of our telco to adopt or gain our services. That's when our business took off. And most critically, I think the most critical success factor looking back was we hired a lot of people not from our traditional line of business. 95% of the people came from a non-telco background. Most of them came from technology, startup companies. I myself had never worked inside a telco. And that, culturally, we were able to build something that was closer to a founder-led startup than something that was born out of a large company or a corporate venture kind of setup. And that's kind of, when I look back, that's kind of one of the first things we had to learn along the way and pivot. So we started off in payments. Payments, honestly, was never the end game for us. It was always a means to an end. And we started in Malaysia, built a fairly large, first 2 years focused on really doubling down on payments. Scan and pay was not a mainstream payment method as it is now. So there was a lot of unknowns. But fortunately, it took off. It took off, and we were able to focus a lot on small transactions and merchants at the bottom of the pyramid. So that thesis held true. The fact that there are merchants who were, or there are businesses where it was possible to displace cash, that thesis held true, and we were able to gain a lot of traction on that. But I think one of the first things we did right was after about 2 years, we decided that payments and looking at the industry landscape was getting commoditized. Everybody was using 2-3 wallets. QR standards were moving towards interoperability, which meant that you probably had more value in having a merchant relationship than a customer relationship, because customer relationships were getting commoditized. So we decided to focus on building a lending business. So very often when you build a payment platform, you forget the other side of the equation, the other side of the platform, the merchant side. And we realized that that was actually where there was potential to monetize a large part of what we had built. We had transaction data, we knew the merchants, a lot of merchants were cash merchants who had become digital, and a lot of them were thin file, they didn't have credit profiles. So we were able to build basically a credit business around that, where the promise was 3-minute approvals dispersed within 24 hours. The only reason it was 24 hours is it was through the banking system. And basically, we could give loans to small merchants who didn't otherwise have the ability to gain access. And that's really where a large part, I would say, was a defining moment in our business, where the center of gravity of our business shifted from what was an early stage payment business to a lending business. And ironically for us, a lot of payment consumer businesses do get into lending, but they get in on the consumer side. We decided to do it on the micro SME side. Primarily because we felt that the productive use of money delivers better returns than the consumptive use of money. And that was a thesis, in hindsight, that worked well for us. To date, we've dispersed almost $1 billion in loans. And then we started thinking about, okay, how do we take this model further? How do we extend it? How do we, build a business? A $100 million loan book is interesting. The funding gap in Malaysia is probably, you talk to different people, $20 billion, $30 billion. How do we access that? How do we build a loan book? And we realized that the markets were not deep enough to build a very large book if you don't solve the funding side of the equation. And that's where we decided that we needed to get a deposit license. And unfortunately enough, at that time, digital banks were coming in vogue. A lot of regulators in the region were coming up with standalone licenses. Malaysia came up with one, and we decided to apply. To date, it's been very successful. We've launched just about 6 months ago. We've got about, this is in ringgit, so it's about 180 million in US dollars in deposits and a loan book of about $30 million. So it's taken off pretty nicely for us. What do we do? What are the fundamental building blocks we built? We built capability around our lending piece. We build our IP around our lending piece. We build the ability to underwrite, the ability to assess customers who don't normally have very thick data about them, the ability to disperse, collect in a matter of minutes. There are a lot of fintechs who've had this journey, and I think we just doubled down on doing that. And by doing that, we were able to really build an ecosystem where our lending business became our core. That became kind of the secret sauce for us, and that's what we continue to develop every single day. And really, we looked at what we have on both sides as an ecosystem, our payment ecosystem, third-party ecosystems, other telcos in our parent company network would basically form a go-to-market layer, a layer in which we could access customers, and it became very, very seamless to do that. And then we needed to solve the funding side of the equation, and depending on which market we were in, we decided that sometimes it makes sense to own a banking license, sometimes it makes sense to access markets for funding, sometimes it makes sense to just get into partnerships. And this, if I can think about it, is kind of where Boost is today and how I would define our business model on a page. My apologies, I'm running a little fast in the interest of time. So a slide on how we connected the dots. So if you think about what we had built a very strong lending engine, and we had built a very strong proprietary lending book. We also had a wallet business where we had built a large number of what I call pseudo deposits. People were putting millions of ringgit into their wallets, not earning any interest, and we couldn't on-lend that, right? So we had effectively a pseudo deposit base and we had a lending base, but we couldn't connect the two. And where the digital bank really came in is to complete the piece of the jigsaw puzzle, where we were essentially able to take a lot of customers who were leaving latent cash with us, encourage them to put more money with us because we were giving them real-life use cases. We were giving them interest on their deposits now, but we had the ability to on-lend that, and that kind of solved the funding piece of the equation for us. And that's really kind of the thesis of how we evolved into digital banking and why digital banking makes sense for us. A lot of people have got into this space because digital banking, sounds very sexy, it's very interesting. It was kind of the vogue or the place to be 2 years ago. For us, it was a very clear strategy. Without having a digital bank license, we felt that we could not complete our model. And that doesn't mean we will do this in every market. We did it in Malaysia because it made sense, depending on the gaps we saw and the licenses that were available and the maturity of the funding markets in that country. So my advice to all of you is think about how you would, when you get into a new line of business, how does it build or enhance your existing business model? Finally, I'll skip this slide in the interest of time and get into this. Finally, one thing we are very big about, so I showed you the slide where we were connecting our lending and our deposit. One thing we made sure is we embedded our banking products and our financial services products from day one. So today, if you are a wallet customer on Boost, you just need to do one step and you can open a bank account. You can swipe all your money from your wallet to your bank account. All our wallet customers have a very easy path to becoming deposit customers. On our lending, something that we've had to learn the hard way, very often a lot of the customers we lend to are not digitally savvy. They're not very digitally literate. So what we try and do is, as opposed to creating a new journey for them, embed ourselves into platforms, embed ourselves into systems that they are familiar with. I mean, just to simplify this, it could be as simple as, and this is a real life example, you have retailers who order, we have a retailer, a retail network we actually fund where basically they order dairy products every day. And on their order system, which is the same order system they've been using for the last 10 years, we've just embedded a single toggle that allows them to either buy for cash or buy for credit. And if they buy for credit, they get the funding from Boost. But in terms of the journey that they have to go, in terms of what a retailer has to do on a day-to-day basis, it's no different than what they had to do the day before they engaged our services. They just need to swipe a toggle. And that's an example of embedded finance, and that's an example of embedded banking. And we've invested heavily in this space, and wherever we've got it right, we've seen adoption, customer adoption being 10x more than trying to cross-sell your products to a customer. So my final point, I think almost out of time, any of you, there's a lot of buzzwords out there, any of you really trying to make embedded finance work? My experience is it does pay dividend because fundamentally you are going to a customer, you are embedding yourselves into an experience that the customer knows, the customer uses on a daily basis, and then it becomes very seamless for the customer to adopt your service. Very often we think about how we are going to convince the customer to adopt our service, download our app, get onto our platform. But that's the wrong type of thinking. We should be thinking about how we are going to embed ourselves into their journeys, their platforms, what they do on a daily basis. And that's kind of my final message. For us, it has paid dividend. We are very excited about the future of Boost and everything we are doing in this space. So thank you for listening to me for the last 15 minutes. And I'm happy if any of you want to catch me after this to ask me any questions about what I've shared. Please feel free to catch me after this. Thank you.